Hey guys, welcome back to my channel. I'm Labhav. Today I'm going to talk about money management, how you can do it effectively with minimal efforts. We all live a very busy life, meeting the professional commitments, taking care of our loved ones, and doing all the day-to-day tasks. In all this, we can lose focus on money management, and we want to essentially keep it simple as well. But does it happen with you that by the end of the month, you have no clue where your money went? You had so many plans, you wanted to save this much, you wanted to spend only this much, you wanted to invest this much, but it didn't happen. At least for me, for a long time, I was struggling with this, and I had no clue what was happening by the end of the month. In one word, I wanted control over my finances with minimal effort, something which works completely on autopilot. My search led me to 3-bucket strategy outlined in Scott Pape's book, The Barefoot Investor. And I have been using this approach for past 3 years now. And from personal experience, I can say that I feel more certain and in control of where my money is at any point. I'm going to share that exact strategy with you here so that you can apply these concepts and get your financial structure built, which enables this strategy to actually work. First of all, a financial disclaimer that I am no finance expert. I'm just speaking from my personal experience and what I learned from Scott's book. So take this one as an educational video. And I'm not trying to recommend any products here as well. I'm just showing what I am using at this point. So with this sorted, you will find the outline of this video here. So feel free to skip to areas which interest you. Now let's get started. The 3-bucket strategy is about dividing your 100% income into 3 different buckets: Blow, Mojo, and Grow. The Blow bucket is where you manage all your day-to-day expenses. Mojo is for any financial emergencies, and Grow is for building long-term wealth. So the central theme of the strategy is to move your money into some predetermined percentage allocations into different accounts so that you have more clarity at any point around how you are going with your savings and investings and everything else. Now to implement this strategy, we need to create 5 bank accounts. Yeah, you heard me right, 5. In one institution, you need to open 2 transaction accounts and 2 high interest saving accounts. So all these 4 accounts will be linked to each other. So you will log in into the account and you will see all of them. Now you have to name all of these 4 accounts in a specific way. So the 2 transactions accounts would be named as daily expenses and splurge. The 2 high interest saving accounts would be named as smile and fire extinguisher. And finally, you will have a 5th bank account. This is with a different institution, different bank, which you will call as Mojo. So with all the 5 bank accounts which we discussed here, you need to find in your country the banks which are not charging you anything for opening an account. So in Australia, Scott recommends ING and UBank. In your country, you can search and find out the zero fees based accounts. Now, as we have this financial infrastructure sorted with the 5 accounts created, let's look at all the 3 buckets one by one and see how your money will move around them. Now, 100% of your paycheck should go into the Blow bucket and not into the Mojo or the Grow buckets, okay? So Blow bucket would be essentially all the 4 accounts which we created with one bank institution, which was daily expenses, splurge, fire extinguisher, and smile. So if your employer can deposit your salary into all of these 4 accounts, great. Otherwise, what you can do, as I do, is move your 100% salary into the daily expenses account, assuming that you get your salary on 1st of every month or your paycheck on 1st of every month. You can set up auto debits so that once you have your salary in your account, you move then 10% of it into the splurge account, another 10% into smile, and finally 20% into fire extinguisher accounts. This will leave out 60% into your daily expenses account. So the idea is that you live off for that whole month, which takes care of all of your expenses, such as rent, EMI, any car loans, any credit card debts, anything of that sort. You take care of it within this 60% of your income. Now don't panic in case 60% is very less for you in terms of your expenses or if your income is too low. What you can do is you can cut down on the 10% which you move into either the splurge or smile accounts. But you can't actually touch the 20% which goes into fire extinguisher. You should aim at moving that 20% consistently. In the book, Scott recommends some benchmark percentages for different kind of expenses which we have in a month. So he says that for housing, which can be rent or home loan, you should be around 30%. For utilities, it should be within 5 to 10%. Transport should be another 5 to 10%. Insurance, 5%. And food, another 5 to 10%. So these are some guidelines. You can look at how your expenses are and plan accordingly. The 10% which you moved into the splurge account is for spending on things which you love. This is for guilt-free spending. So for me personally, 10% of my take-home pay for splurge is a bit higher. So again, keep this as a guideline and decide for yourself what is the right percentage for you. So I keep it a bit less So as both daily expenses and splurge are transactions accounts, you will have a separate ATM card for them. What you can do is add a note on them, calling them as daily expenses and other one as splurge, and keeping both of them in your wallet so that once you remove one of them, it is obvious which one you are taking out and you spend accordingly. So for any daily expenses, going to grocery and things like that, you will use the daily expenses card. So for a latte or any shopping which you want to do for yourself, any clothes or food, you will use the splurge card. So what this would do is it will help you stick to the plan which you decided for yourself on the first of the month. You decided at that time that I'm going to splurge only 10% of my salary. So this system of having different cards would help you achieve that. Smile account, where we move 10% of our salary, is for big goals such as international travels, vacations, or weddings which is coming up. So big expenses which are a bit far off. So you can start planning for them now onwards. So you can move 10% consistently, and eventually this would make you smile. So that's why the name is Smile. Fire extinguisher, where 20% of your salary was moved, would be used to clear any credit card debt, or to pay off your mortgage, or to save for your house deposit. Both Smile and Fire Extinguisher accounts are high interest saving accounts, so you don't actually get an ATM card with them. So this helps in terms of achieving the saving targets for both of them, as you can't easily spend them on things which you don't want to, and indirectly it helps. Mojo bucket is for any financial emergencies in life. This can be losing your job, going for an international travel, or any health emergency where you need immediate funds. Now you can't keep this money in an offset account or a redraw account because you need this as an emergency on the spot, and you will not have that flexibility with your mortgage. So it is important that you have it in a bank and it is easily accessible. So for this reason, we created that Mojo account. So the idea is that you should begin with a deposit of at least $2,000 into it. Now, in case you don't have $2,000 with you right now, consider going for a garage sale, selling few things, or doing some extra part-time work so that you can get that cash and deposit in for an emergency. In the long term, you want to build at least 3 months of your daily expenses, the fixed cost which you have in your life, to be saved up in an emergency account, that is in the Mojo account. Now you might be wondering, where will I get this Mojo to be increased from 2,000 to 3 months of my expenses? It would actually come from the fire extinguisher accounts. So if you remember, in fire extinguisher account where we were moving 20% of our salary, from where we were clearing the debts. Once those debts are cleared, then you can start focusing on building your Mojo for 3 months. If you are wondering what is the difference between fire extinguisher and Mojo, fire extinguisher is to clear any debts you have, and Mojo is for any future payments or emergencies and planning for them. Grow Bucket is aimed at making you richer every day. So this is where your super goes. So here in Australia we call it super, in US it is called as 401k, in India as Provident Fund. So here 9.5% of the salary automatically goes into the super account, and the growth bucket will also include any other investments which you have, maybe shares or any investment property or investment bonds for your kids. Now where will you get the funds for the grow bucket? So once you have used your 20% of your fire extinguishers for clearing the debts, then you build 3 months of your Mojo. Finally, once your 3 months of Mojo is built, then the final step is to move 20% of your fire extinguishers account into the growth bucket. Then you will start investing it for whatever your aim is, be it investing in shares, buying an investment property, or buying an investment bond for a kid. If you have a partner, Scott recommends to have one joint account. This way you will be more aligned with your partner, and rather than having separate accounts. So your both salaries should go into one daily expenses account. So this is the 3 bucket strategy. I hope that you will consider applying it, and you might find that in the beginning it is too much, 5 different accounts for same things which you can actually do with one, but I can assure you that you will have more clarity and control over your money after that. Try this out for a few months and then decide if you want to stick it to it or not. At some point I'll be doing a detailed review of the Barefoot Investor book in this channel, so please consider subscribing, and if you like this video, give it a thumbs up and share it with your friends. See you in the next one. Bye.